Hello, and thank you for joining us today for this Edward Jones webinar, How Does Socially Responsible Investing Work? My name is Sandy Miller, and I'm going to be your host. I'm excited to have three industry professionals on our panel today, and I'll introduce them in just a minute. But before we get going, let me highlight a few of the features on your screen that we'll be using. On your screen right now, you should already see a video window with me inside. There should be another window with our presentation slides and a third window for our Q&A feature. If for some reason you have any difficulty during the program, you can click on the help icon at the bottom of your screen. That's the black question mark inside the yellow circle. This is for any technical questions you may have. We also have a team on standby ready to assist you if at any time during our discussion you have a question or would like clarification on a point. Just click on the Q&A icon, which is the third button from the left at the bottom of your screen. That will allow you to send in your questions. We'll do our best to answer your questions in the allotted time we're given. But if your question is not answered, please follow up with your Edward Jones financial advisor. If you don't have an Edward Jones financial advisor, please click on the Find an FA widget below. We also have a lot of helpful resources and information available for you inside the resources icon, which is located next to the Q&A icon. All right, now that you know your way around, let's get started. More and more investors are considering sustainable investing opportunities. Some are motivated to improve their investment decisions. Others want to align their portfolios with their values. Perhaps you want to encourage better corporate behavior or make a positive environmental or social impact. Regardless of your reason, there are many ways to invest sustainably. Today, we brought together industry professionals to offer guidance on the possible investment performance benefits, potential trade-offs, and the best approach for investors to take when it comes to sustainable investing. I'd like to introduce Edward Jones Financial Advisor, Nick Gernhard, Edward Jones Director in Securities Research, Robin Dietrich, and from Calvert Research and Management, Anthony Ames. Robin, let's get right into it. There are a ton of terms being tossed around: sustainable investing, ESG investing, socially responsible investing, values-based investing. To make sure that we're all on the same page, let's start with the big picture around sustainable investing.
All right, thank you. You are right, Sandy. There are many terms being used in the industry today to describe several different methods of this type of investing. So it's not surprising that this is a point of confusion for many. And these various strategies can have very different objectives and potential outcomes. So it's important that we spend some time understanding the differences. At Edward Jones, we are referring to all strategies under one big umbrella we are calling sustainable investing. We define this simply as investing your money in a socially conscious way. Our guidance at Edward Jones is that sustainable investing and all the options that we will discuss today should be considered as a client preference or a choice when building your portfolio. We believe you can build a well-diversified portfolio and achieve your financial goals with or without sustainable investments. However, a sustainable investing approach may help you meet your own personal, unique, non-financial goals. So what is it? Sustainable investing includes strategies that we bucket into two distinct categories. The first is ESG investing, and this takes a comprehensive view of environmental, social, and governance issues. The second bucket is values-based investing. This often has a more specific or narrow focus that aims to align an investor's personal values to their portfolio.
Nick, can you take the first one and tell us more about ESG investing?
Sure. ESG investing incorporates environmental, social, and governance considerations along with traditional financial measures. So we can take a look at some examples of each of those to flesh out the idea a little bit more. The environmental considerations, includes a company's use of fossil fuels, their carbon emissions, pollution and waste management, and the use of natural resources such as water. Social considerations include how a company treats its employees from a workplace safety, equal pay, or diversity standpoint, but also includes product recalls and even how a company is involved in the local community. Governance includes understanding a company's financial reporting transparency, their executive pay, and business ethics. Many of these considerations have been a long-standing piece of fundamental analysis, while others are newer to the analysis process. I've used an analogy that seems to resonate really well with people when explaining how ESG criteria are being used in investment analysis. So we've used blood tests for a long time to inform us about our health. So blood tests of 50 years ago versus today are very different. These days, we're able to screen for and identify a greater number of risk factors, and we use that information to make an informed choice about recommendations for improving our health. Incorporating ESG metrics when evaluating a company is very similar to this additional layer of screening. It does not replace traditional analysis. Instead, it's used to supplement that analysis a little bit further.
All right, let's stay on this topic of ESG investing and go a little more in depth. Anthony, what are the ways investors can apply ESG investing to their portfolio decisions?
Sure, happy to handle that, Sandy. And I think this will align with what you've heard from Robin and Nick as well. So as we look at sort of the landscape, there really are two primary approaches to sustainable investing. The first we sort of described as ESG integration, which involves certainly the consideration of how companies are managing the environmental, social, and governance issues that they face. But it is really with a goal of improving the risk-adjusted performance of that portfolio. So increasingly, portfolio managers are using ESG information, particularly that is financially material to the companies that they are thinking about investing in, and those sort of considerations are reflected in the portfolio. Some companies maybe that face risk based on how they're managing these issues might not get invested in, and then other companies that are successfully managing those issues are invested in. So it's all about sort of delivering a better risk-adjusted performance outcome for the client using ESG integration. Another approach, I would say the other prominent approach is what we describe as sort of intentional ESG investing. And this is also about considering how companies are managing the ESG factors that they face, particularly those that are financially material, but there is a clear sort of ESG outcome that is desired as well. So it's still about assessing companies' performance and investing in those companies that are doing a good job managing those ESG issues, not investing in the companies that maybe face more risk, but there might be a particular outcome, whether it's a portfolio with lower carbon emissions or a portfolio with better gender diversity, particularly as it relates to the board of directors of that company, perhaps no exposure to fossil fuel reserves or controversial weapons, for instance, that some investors do not want to have exposure to in their portfolio. So those are really the two approaches that we see in the industry, the sort of integration of ESG to improve risk and performance outcomes, and then sort of intentional ESG investing as well.
Robin, what then is Edward Jones's advice on ESG investing?
We recommend talking with your financial advisor to fully consider your goals, both financial goals and non-financial goals, including investment performance, to help determine which strategy is right for you. And our guidance on ESG investing, both the integrated and intentional approaches that Anthony just spoke of, we consider appropriate choices for investors. And we believe are performance neutral. In other words, these should not detract from a portfolio's performance.
Nick, what options do clients have at Edward Jones if they're interested in pursuing ESG investing?
Yeah, as Anthony mentioned, ESG integration is something that many traditional money managers and analysts are using increasingly in their fundamental analysis of companies. Likewise, here at Edward Jones, our equity analysts are looking at those environmental, social, and governance data pieces and assessing the risks and opportunities for companies that we cover. They determine if those factors are financially material to the company's value, and then they use it as part of their recommendation on the stock. For an intentional approach, there are many Edward Jones recommended mutual funds and ETFs that prioritize ESG across various asset classes, and those can be layered into a diversified portfolio. So whether you're primarily looking for additional screening or maybe want to be a bit more intentional, we do have options for you.
What about socially responsible investing and values-based investing? What are those, and is there a difference between them, Anthony?
It's a great question, Sandy, because this we've seen really incredible sort of evolution in the space, and the great news for investors is that there are many, many options now that were not the case, 10, 15 years ago. I think there is a kind of suite of offerings in the industry that I would sort of characterize as thematic offerings. And this is typically where the portfolio manager is trying to identify and really prioritize a particular environmental or social theme in building the portfolio. Some examples of this approach would be a portfolio focused on renewable energy or water, companies that are involved with sort of the water cycle, if you will, infrastructure and technology and the like. Another thematic approach would be one focused on gender diversity, identifying companies that have better gender diversity than other companies. And then there's also a sort of a suite of offerings that fall into the impact category. And that's where a very specific sort of outcome, typically environmental outcome, is prioritized. We've seen significant growth in the green bond market over the last 10 years. And so issuers are putting out green bonds where investors can invest in these bonds, and then the proceeds of those bonds are going to some sort of environmentally beneficial project, like a water infrastructure project, for instance. Faith-based is another approach to investing, and this is increasingly popular, and this is where a particular sort of denominational faith is prioritized, like Catholic values, for instance. And then lastly, there's the traditional sort of exclusionary or screening approach, and this is where a portfolio is kind of customized for an investor's very specific priorities. They don't want to have exposure to certain companies based on very specific issue areas. Examples that we see, frequently are, tobacco, fossil fuels, controversial weapons, and gambling. So the exclusionary approach allows to deliver a portfolio that does not have access or exposure to some of these companies and issue areas.
Robin, what investment considerations should investors understand if they choose to follow a values-based approach?
The values-based investments are another choice we provide at Edward Jones. And because values-based investing, by definition, seeks to align an investor's portfolio with their own personal values, these investments can be more narrow in focus. So in addition, this focus can mean that those value goals are prioritized above financial performance. And while all investments can perform differently over time, investors that are choosing a values-based approach should understand that the potential trade-offs are for potentially lower returns and or higher risk. And today, we offer many thematic and faith-based mutual funds and ETFs. However, we are more limited in our options for impact investing, as these are often private investments. One way to implement the exclusionary investing that Anthony mentioned, which is to avoid the companies that operate in certain businesses, such as weapons or tobacco, is through the Edward Jones Advisory Solutions Unified Managed Account Program, and that invests in separately managed allocations or SMAs.
Now, while we've been hearing these terms, a quick Google search shows that the majority of investors are still unfamiliar with this type of investing. Anthony, why do you think that is?
Well, it's a fair question, Sandy, and the reality is that there's been really explosive growth in the industry over the last 10 years, really even over the last 5 years, and I've got a couple of data points that I'll share. But the growth has exploded, I would say, has surged because the approach has also really evolved, particularly in the last 10 years. If we went back 10 years ago, very few companies were actually disclosing their performance on environmental, social, and governance issues. And so we as investors didn't have really the best information to make investment decisions. Today, the vast majority of operating companies, publicly traded companies, are offering some disclosure, kind of a window into their performance as it relates to ESG issues. The other big discovery, which happened in around 2015 when the group of academics kind of published the first paper on this, is this notion of financial materiality, that these ESG issues do have the potential of affecting companies' performance, not only their operating performance, but also how their securities do in the capital markets. And so I think this evolution and sort of the discovery by the investment management community that we can do a better job of managing these portfolios is what is behind some of this growth. You know, and if you just look at Morningstar, for instance, which is the big kind of third-party evaluator of mutual funds and ETFs, we were back in 2018, I think about $5 billion across the industry on a net basis went into kind of a universe of intentional ESG funds. The following year, it grew fourfold to 20 billion. In 2020, it was 50 billion. And then last year, $70 billion went into these intentional ESG funds. It's been one of the fastest growing areas of the markets. And so despite maybe the reality that many investors aren't aware of the approach, increasingly they are, and there's really, it's been a significant area of very strong growth.
Anthony, what kind of person is drawn to sustainable investing?
Also a good question, Sandy. So I would say that we are seeing interest really across the generational spectrum. So literally, you see some of the surveys that are done out there by various firms. The interest in sustainable investing is increasing across all the generations. The one generational cohort, the one generation where sort of interest is higher and frankly off the charts, is with the millennial generation, who I think are somewhere between late 20s and 40 years old at this point. This is really the generation that has grown up with sort of the greening of society, if you will. This is the generation that has seen the dramatic development of electric vehicles and other other issues like that. So again, I think interest is across the board. It's really driven by the millennial generation. I think that's behind a lot of the sort of surging interest. And so there's some of the industry flow data that I just shared. But again, we're seeing interest across the board.
Nick, how are the clients talking about this with you? And if they're not, what questions should they be asking if they're intrigued yet also confused by this type of investing?
Yeah, well, I've actually found that most clients aren't really asking about it, but that doesn't necessarily mean that they're not interested. It might just be that they don't know much about this type of investing. There's a lot of information out there. They may be confused about things, or maybe they just don't even know that we offer this type of investing at Edward Jones. So an important opening question is, why has ESG become such a hot topic, and why now? So once the conversation is started, then we can address other topics, such as what are the opportunities and risks that are out there? How are those opportunities and risks evaluated? And which companies are most affected by those ESG measures? So I know Anthony has said this a couple of times. A lot of that has to do with materiality. So that would be an important concept to address also. In addition, clients may have questions regarding how ESG affects not only US stocks, but also international investments and bonds as well. So perhaps the most important question of all is, what actions are companies and money managers around the world taking in response to this new environment?
Robin, bearing those questions in mind, besides contacting their financial advisor, what else should a client be thinking about when deciding if sustainable investing is for them?
Well, Sandy, as we talk to our clients about this topic, there is a great deal of enthusiasm, to be sure, about the ability to invest with purpose, as well as some concerns. We think it's important to consider what is important to you and answer the question for yourself: how do you want your money working for you? It's also important to understand that the industry is evolving and sustainable investing is still new in some respect. There are challenges today still with reliable data collection, for instance, or disclosure from companies, and a lack of a standardized way to evaluate companies and measure performance. But once you have considered these things and considered your financial goals and non-financial goals, we can help you determine the best strategy. We believe sustainable investing can have a place and be an appropriate choice in your portfolio.
Anthony, greenwashing is something that I see referenced in articles frequently. Can you expand further on this, and how should it impact the investment decision?
Yeah, thanks, Sandy. So greenwashing is a thing, and so it's something that we definitely follow and need to be mindful of. You know, the reality is that there are many different approaches to sustainable investing. John Hale, who runs the Morningstar research part of the organization that follows the industry closely, he recently said that this is not a monolith, was his word. It's a big tent, and there are a lot of different approaches and a lot of different investors inside this tent doing it very differently. It could very well be that there are companies and even asset managers that focus more on sort of the marketing or the appearance of having strong sustainable investing credentials to sort of, benefit from that. But the reality is that there are many competent managers who are using comprehensive and thoughtful approaches to investing in a sustainable way. I would say that the responsibility is really on the investors and with the help of their financial advisors to look for the evidence that a portfolio manager or that a sustainable investment is sort of intentionally and comprehensively doing that work. You can look for impact metrics and exposures that many managers are producing. You can actually consider a proxy voting record. There are increasingly shareholder proposals that are filed at companies that support ESG issues and priorities, and investors have the opportunity to kind of throw their support behind those. That's public record, and investors can look at that. Fortunately, there are resources out there. I think we're actually going to share some of them today to help with this work.
Nick, I want to build off of what Robin said. What kind of education and resources do you provide for clients when it comes to sustainable investing?
Yeah, well, mostly to start with, it's a conversation with clients, just really getting it out there and asking them if they've heard about it. If they express more interest, then we can dig a little bit deeper and focus on what they're mostly concerned about. They might just want an additional layer of analysis offered by ESG integration. However, some clients may also want to achieve more specific non-financial goals, such as reducing the carbon footprint of their portfolio. In either case, we have some great resources available at Edward Jones, like our Sustainable Investing Strategy Report, that we can provide for our clients.
Anthony, in terms of education, what are the top 3 things investors should know or keep in mind about sustainable investing?
Yeah, this is really important. So the first thing I think is to develop sort of a contemporary or modern understanding of what sustainable investing is. This is about deep research on companies and evaluating how these companies are managing their material ESG issues in addition to traditional financial sort of considerations. And then values-based and negative screening is around customizing a portfolio to meet a client's very specific sort of values or priorities they would like to see in their portfolio. Second, and this comes up all the time, it's often the elephant in the room, which is how do these strategies perform? There is I would say, a misconception that sustainable investing leads to underperformance. The reality is that there have been many, many studies that have looked at this closely. And of course, depending on the strategy and the approach, again, it's a big tent and there are many different approaches. But sustainable investing could be positive from a performance perspective. It could be neutral. It could also detract from performance. So that it really depends on the approach, also depends on sort of the market environment that we are in as well. And then the third, and we haven't really discussed this yet, but there is also really rich opportunity to better understand engagement. I mentioned proxy voting, I think, on my last point that I made, but increasingly investors are engaging with the companies in which they invest with the goal of trying to get them to sort of improve their performance in financially material ESG issues. And that's a really interesting kind of part of the process, and good for investors to be aware of that as well.
Nick, I'm guessing that sustainable investing may not be the right fit for everyone. Is that true?
Well, yeah, that is true. Not all clients are interested in this type of investing. What we're doing by offering these options is expanding client choices. For clients who do gravitate towards the ideas behind sustainable investing, we can now offer them a wider selection of investment options. For those who prefer a more traditional approach, there's no need to necessarily change anything that they're doing. And because ESG investing has been shown to be relatively performance neutral when compared to so-called traditional investing, we can feel really confident that any of the well-diversified portfolios that we offer our clients will help them achieve their long-term financial goals. However, I would like to highlight an important note here, and that is traditional investing and sustainable investing are not necessarily mutually exclusive. For instance, many of the companies that you may find in an ESG intentional fund will also be included in a traditional fund as well. And the reason is pretty simple. A lot of well-run companies with strong fundamentals just happen to get high scores on their ESG metrics as well. And that makes sense because having satisfied employees, using less energy, having robust cybersecurity measures in place can all help produce beneficial outcomes. For the most part, these are just good business practices. And some of those practices can lead to improved social and environmental outcomes. So whether it's intentional or not, many people are invested in these companies through traditional funds, as well as those that are specifically labeled as ESG or sustainable.
Nick, any additional actions for interested clients or investors to take if they want to learn more about sustainable investing?
Yeah, these days there's no lack of access to information. However, that can actually be part of the problem. Sifting through articles and blogs to find what's credible and useful can be a really daunting task. And taking action based on incomplete or inaccurate information can throw you off course. That's where advisors, as curators of information, can really shine. My advice would be to start with a conversation with your financial advisor. Let them know about your interest with regard to sustainable investing, and then use the resources that we have available. If investors seek out information on their own, be careful to vet your sources and stick with industry leaders that have been in this business for a while. As an additional layer of due diligence, you may want to run the information by your advisor before making any big decisions. This not only applies to sustainable investing, but more broadly to any type of decision that might affect your financial goals.
One final question for all three of you. What should our audience take away from today's webinar? Nick, I'm going to start with you.
Yeah, I think it's important to view investing as a circular relationship between investments and the world. And that is, the world impacts our investments and our investments can impact the world. So for instance, there was a drought in Taiwan in 2021, and it put additional constraints on the world's biggest computer chip manufacturer at the very worst possible time. Other extreme weather events like wildfires and hurricanes, tornadoes are increasingly causing significant business disruptions. Striking workers, and those who are quitting their jobs and looking for better ones, well, that highlights the importance of maintaining a satisfied workforce. These are all examples of how the world is impacting our investments. But however, lately there's been an increased global focus on how investments are impacting the world. People are starting to ask how business activity may be contributing to extreme weather and pollution. They're asking how workers are being treated, not only within a company, but all the way down its supply chain. And they're starting to recognize the circular relationship. So, for instance, more satisfied workers can lead to better employee retention, and as a result, less disruption to business. So these concepts can be applied to many facets of a company's operations, but they just happen to play out quite a bit in the realm of sustainable investing. This is one of the main reasons that ESG integration is becoming more commonplace among asset managers all over the world these days.
And Anthony, same question.
Yeah, well, thanks so much for this opportunity to join you all today, Sandy. I think Nick just did a great job of sort of summarizing, and I totally echo his points that we face many challenges today globally. Governments are taking up these issues, to be sure, but so are companies. Operating companies are dealing with these issues, and frankly, some of the best companies through their products and services. Sustainable investing provides the opportunity, sort of a lens to examine and assess these companies, really with a goal of identifying those companies that are doing the best job managing these issues. So it can be about being part of the solution, and at the very least, building a portfolio that recognizes and considers these risks and is potentially better positioned as a result. I think that sustainable investing today is also about building better portfolios that meet the needs, potentially better portfolios that meet the needs of return-seeking investors as well. So as Nick said, this is not about sort of concessionary or a goal of concessionary performance. This is a goal to generate competitive performance, and I think that's that's a great goal through this process. And lastly, again, we haven't spent a lot of time on it today, but there's this opportunity to engage with companies to try to get them to improve their performance, and voting our proxies and doing sort of deep corporate engagement that can also be additive to the overall process in seeking portfolios that are designed to offer the best kind of risk-adjusted performance possible.
And Robin, what do you hope our audience takes away from today's webinar?
I also want to thank Nick and Anthony for sharing their insights. And I think what we've heard today is that this is an exciting space. Investors have so many options really to put their money to work in ways that inspire them, and they can seek to make positive change. Our purpose at Edward Jones is to partner for positive impact, to improve the lives of our clients and colleagues, and to better our communities and society. And we get up every day to help our clients and their families achieve what's the most important to them. We want to help our clients meet their financial goals and their non-financial goals. Sustainable investing is one way to accomplish this. And we recommend a variety of sustainable investments today to be considered as an appropriate choice in your portfolio.
Great information today. Thanks to all of you for your insight. As I mentioned earlier, we have several resources that we hope will help you during this time. Be sure to check them out by going to the resource icon on your screen. We're now going to start the Q&A portion of the program. We have a team of subject matter experts waiting online to answer your questions through the Q&A widget. Please remember that there will not be any video during this portion. You will only see a slide prompting you that the Q&A is now in session, but rest assured the webinar is still live. We'll do our best to answer your questions during the allotted time. If your question is not answered, please follow up with your Edward Jones financial advisor. If you don't have an Edward Jones financial advisor, please click on the Find an FA widget below. I also want to remind you that this broadcast will be available again on demand using the same link you used to register for today's program. Please note our upcoming webinar as well. Thanks again for joining us, and please enjoy the rest of your day.